Hello and welcome. You're watching The Global Reset on CNBC-TV18 Prime with me, Prashant Nair. This is the show where we connect the dots between what's happening locally with what's happening globally. And I must say, over the last 24 hours, a lot has happened locally, more locally as compared to globally. So today on the show, we'll actually focus on exactly that, local and global as well, more local than global than we usually do. In a short bit, we'll be joined by Gargi Pal Chaudhuri, who is the Managing Director, Chief Investment and Portfolio Strategist for Americas at BlackRock, to discuss Donald Trump's tariffs, markets, the Fed's independence, and more. And on the local front, the big story, which of course came through last evening, was GST Council's approval of a two-slab rate structure, along with a special 40% tax rate on salient luxury goods. And that's what the markets here locally are reacting to in a big way. And we'll sort of get you voices, top-notch voices on it in just a bit from now. But before I do all of that, any of that, let me just quickly run you through what's happened in the last 12 hours or so. US President Donald Trump has moved the Supreme Court in the US over the ruling that said that most of his tariffs were illegal. Speaking to reporters, he said that the US might have to unwind trade deals it reached with the European Union, Japan and South Korea, among others, if it loses the Supreme Court tariff case. He also warned that a loss would cause the US and a court to suffer so greatly, end of quote, even saying it could become a third world nation. It's not that it's the first time he said this without the tariffs. Listen in.
We're in a much better position. We have trillions of dollars coming into our country. If we didn't have tariffs, we would be a very poor nation, and we would be taken advantage of by every other nation in the world, friend and foe. We're not going to let that happen. And we have a very, very big case in the Supreme Court. I can only say this. Our country has a chance to be unbelievably rich again, but it can also be unbelievably poor again. If we don't win that case, our country is going to suffer so greatly.
What's the backup plan, sir?
But I think we're going to have a big victory. Even if you look at the people that brought the case, they're foreign-oriented. They're foreign. Countries have taken advantage of the United States for so many years. And I started with China. Last term, I took in hundreds of billions of dollars in tariffs from China. But when COVID came, the last thing I was going to do is we're going to tariff France and Italy and others, Spain, when they were doing so badly. But now we made a deal with the European Union where they're paying us almost $1 trillion, and they're happy to do it. You know what? They're happy. It's done. These deals are all done. I guess we'd have to unwind them. We've done deals with Japan, with South Korea. We've done deals with many countries and others to come. And if we didn't have the power, prestige, and dignity of tariffs, and I used them wisely, and people respect America again, and we've become a rich country again. The money coming in is incredible. And again, they use them on us. If we didn't have them, they would use them on us, and we would have no way to fight them. We would be a third world nation.
Third world nation. The US president was also asked about the China military parade that also saw Russian President Putin and North Korean leader Kim Jong-un in attendance when asked if he thought the leaders were conspiring against the US and would he consider slapping additional sanctions on Russia. This is what he had to say.
Well, I've already done that with regard to India, and we're doing it with regard to other things. And I put out a truth last night. You saw that. And I was the one that brought it up. I said, they're only doing this. They're looking to, when they did what they did, I thought it was a beautiful ceremony. I thought it was very, very impressive. But I understood the reason they were doing it, and they were hoping I was watching, and I was watching. My relationship with all of them is very good. We're going to find out how good it is over the next week or two. I think that we helped China very much, as you know.
Okay, well, Gargi Pal Chaudhuri of BlackRock is now with us, right, to run us through, as promised, what she makes of all of this. Gargi, great to have you with us here. Appreciate your time here on CNBC-TV18 Prime. Let me start by asking you, there are many who believe that the additional 25% tariffs in India will be short-lived. Something will be worked out in the next 1 month. I mean, of course, it's up in the air, but there are many who believe it could be. Any way to tell, Gargi?
Sure. First of all, thank you so much for having me. It's a pleasure to be here with you again. And with respect to your question, I think, for people like you and I who are really not in the ins within the administration that's deciding on the tariff levels, it's hard to say whether it's going to be short-lived for the next month or even 6 months. But what I will say, and I think that's important for people investing globally in India and in the US and otherwise, is I think that what we've seen so far is the impact of tariffs. And obviously, we've seen that rolling in a little bit in the US has come through three different channels, right? So it's first of all, it's come through very slowly. It's obviously being a little bit absorbed by the consumer. They're having to pay slightly higher prices, but both the importers and exporters are also bearing some brunt of it. So thinking back to April, what we and all market participants had thought around what the tariff effects might have been and how that might look for your consumption basket versus the reality of it coming through in a much slower pace, as well as getting absorbed in three different directions, not just all by the end consumer, I think will definitely play a role in those investors' minds. And frankly, for the end user, for many of your listeners right now who might be worried about, what their experience is going to be.
Gargi, let me ask you this from the other end now. Could there be, I mean, before de-escalation, some sort of escalation, one step higher before there is a climb down? I'm talking specifically about US and India.
Look, there's always a chance of furthering of geopolitical risks and volatility. If there is escalation, if there is some kind of expectation of heightened tariff rates, from what we have seen in the past, often they are used as a negotiation tactic. I think what's important here, especially for Indian investors, and when we look at our economics team and what they're thinking in terms of the impact on GDP. Of course, there's going to be an impact on GDP for the US as well as for the Indian economy. But given the Indian economy being quite close, I think the impact is right now seeming to be, with somewhere around 0.3 to 0.5%. It's not, which is not nothing, but it's not massive. So yes, there could be potential escalations. There could also possibly be potential de-escalations. So I would tell investors to think broadly, not through, how should I trade this for the next 1 month or 1 week, but broadly, what are some of the fundamentals that are going to remain globally, despite the tariff news, which might be on top of our mind and in the front page? And in the US, we just came out with our fall outlook. One of the things that we're talking about is continuing to focus on companies which have those strong earnings power. And in the US, those are technically large cap growth companies that are continuing to generate some of those really high earnings results and therefore returns.
No, absolutely. Gargi, let me get your thoughts on the US market now. Do you get a sense, although last night US markets were up 0.5% on the S&P, 1% on the Nasdaq, but do you sense there is a pullback around the corner, especially led by the hugely outperforming AI mega cap theme?
So one of the things that we're all looking at is just some of the seasonalities that are very prevalent, especially into the month of September, which obviously we're in the beginning of that. And if we look back at the last 5, 10, and 15 years, September has been a weaker market. Whether you look at the S&P 500 or whether you look at broader global indices, you've had a little bit of a pullback. And I think what one also has to pay attention to for 2025 in particular in the US markets is that we have seen that tremendous, post-Liberation Day rally of, call it 31, 32%. At the same time that, there has been some concerns around how high valuations might be, especially when we compare some of the traditional PE ratios versus their 10-year average. And of course, there is a little bit of a premium there. So I acknowledge that the seasonalities right now around September and perhaps even the first part of October are not great. And sometimes, markets have a little bit of self-fulfilling prophecy. Everyone knows that September is a weaker month, so you get a strong or a weaker data, and people are more likely maybe to go out and sell. And then you have year-end for mutual funds, and there's some tax loss related selling. So there are many drivers of this September seasonality. What I think investors, again, should focus on, and we talk about this in our fall investment directions piece, is really in moments like this, especially when the seasonality in the very short term, 4 to 6 weeks, tend to be weaker, focusing on fundamentals are really, really important. So when you look at the US tech sector, or for example, for US large cap growth broadly, and if you look at the year-to-date returns, it's not actually meaningfully coming from that PE multiple expansion. What it's coming from is earnings growth. If we look at just second quarter earnings, right? If you look at tech, you got about 22% earnings growth in tech, and overall, obviously, you got an 11.5% earnings growth. Compare that to the non-tech parts of the market, which was significantly lower. So I think that there is continuing to follow where we expect earnings growth to come from in Q3, Q4, and beyond, which continues to be large cap. I think focusing on that fundamental, especially now when the market is a little bit more vulnerable to pullback. So yes, those may happen, but I think that mostly will be used as an opportunity to go back to some of these higher convictions, AI related, large cap related, quality related trades.
That's equity markets. Any strong views on the broader US dollar, the US dollar index, or the bond market, bond yields?
Absolutely. So I think, especially given we're in September, we have to acknowledge that chances are very high, and the market's pricing in close to 90% likelihood of the Fed in their September meeting, September 17th, coming out and sort of cutting interest rates or resuming their rate cutting cycle. Obviously, they started cutting rates last year and then sort of bringing that back on right now. We do expect them to cut 25 basis points. Chair Powell hinted at that very strongly at their Jackson Hole symposium. One of the things that we think is really important for investors to think about right now is really continuing to focus on the income in the fixed income market. So the rate cut is coming. It's more or less priced in by the market. We think there's going to more likely be one more rate cut by the end of this year. So one in September, more likely than not one in December, assuming that the data trajectory, especially on the inflation front, remains where it is now. And I think what that creates is a very strong opportunity for investors to continue to step out of cash. We've seen a lot of inflows into cash and cash-like products. And we're telling investors that in a world where you have the Fed that's willing to cut rates at the same time as there is no concern around recession. So that's important, right? We're not necessarily calling for a global or even a US recession at this time, but the Fed is bringing rates closer to that neutral level. I think at this point, stepping out of cash and garnering yourself some yield in fixed income markets, but focusing very much on the 3 to 7 year part of the curve. That's something that we're feeling very strongly about. And then you asked this question on the dollar, and I think we should certainly think about FX cycles as being very important. So when we look at US dollar moves, they don't happen in isolation. Usually you find US dollar moving stronger or weaker in multi-year cycles. So obviously, year to date, we've begun to see some of that decline. We think it's likely that that can continue to happen. And if that continues to happen, especially in an easing cycle when the Fed starts resuming their rate cutting cycle later this month, we think that that's going to create some incredible opportunities again in international markets. So, weaker dollar that enhances returns for international markets. Many U.S. investors are often underweight to international markets, so they're going to try very hard to catch up to that. So there's going to be that resumed focus on international markets. We're telling investors to do that, to focus on the large cap and quality and tech parts of US markets, and to bolster that with allocations to international markets, and then focusing on clipping yield and clipping coupon in that 3 to 7 year part of the fixed income market, which is really important, especially as we go towards a Fed cutting cycle.
A related question, but maybe not directly, is the market still worried about Trump's criticism of the Fed and his attempts to fire Governor Lisa Cook? She's, of course, pushing back.
Yeah, so the two things that I think we should all be looking out for, especially as you're thinking about questions related to what might be the future of the FOMC composition, the two things that I look at is the steepness of the yield curve. So to what extent, if you're looking at the very front end of the yield curve, so tenors up to maybe 2 or 3 or 5 years, versus the very long end of the yield curve, so tenors higher than 10-year, to what extent are investors demanding higher compensation to own US Treasury bonds or US corporate credit bonds that are slightly higher slightly longer in their duration? And to the extent that investors are asking for more and more compensation to own that longer tenor in the market, I think that's something that certainly will be something that we watch for with respect to FOMC composition. So, continued sort of focus on the front end yields coming down, whereas long end yields might, sort of not come down at the same pace or actually even rise further. So that spread is something that we're watching, and we've obviously seen that yield curve steepen or that spread widen, and investors asking for more compensation in the longer end to hold a treasury bond for 30 years versus 5 years. The other thing that we're watching for is expectations of inflation. So if you are concerned around sort of policy mismatch versus what should be given this level of unemployment rate and this level of inflation, one of the signals in the market is certainly inflation expectations. Frankly, inflation expectations have been quite tame. Yes, they've moved up ever so slightly, but not in an eyebrow popping, eyebrow raising way. Those are the two things we are watching. Obviously, we don't know what the future of the FOMC committee is going to look like. We know there's one governor position that is currently open, which is likely to be filled sometime soon, and there could be others. We just don't know. It's a lot of things in the court right now, and neither you nor me have that insight into how those will resolve. But watching those two market-led indicators, what inflation expectations are in the market, as well as how much term premium, how much compensation is being required for the long end of owning treasuries, that will tell us what the market's expecting. And I think both the Federal Reserve, as well as policymakers, as well as the White House, watch that pretty closely.
Gargi, we'll leave it there. Interesting conversation. Thank you very much for joining us. Really appreciate your time here. Don't go anywhere. We're going to take a quick commercial break here. And then we'll now focus on the local, the big GST cuts which were announced. And we really spoke to some of the best people across industry segments to understand what the implications will be. Will these cuts result in a consumption boost? Stay with us. Coming up. Welcome back. You're with us here on the Global Reset. The big domestic headline that we are tracking, the Goods and Services Tax Council, the GST Council, approving a complete overhaul of India's consumption tax since its launch in 2017, slashing duties on household essentials, medicines, small cars and appliances, and affecting everything from toothpaste and insurance to tractors and cement. The long-awaited GST2 regime is set to kick in from the 22nd of September, basically right at the beginning of the festive season. The revamped duty structure will replace the existing four slabs, which was 5, 12, 18 and 28%. With a simplified two-rate system under the new framework, essential or merit goods will attract a 5% tax, while most goods and services will fall under the 18% standard rate. A special 40% range slab has also been proposed for select items such as high-end cars, tobacco and cigarettes, often referred to as sin goods or demerit goods. Billed as a historic Diwali gift for citizens and businesses, Finance Minister Nirmala Sitharaman called the reform structural, largely aimed at the ease of living for Indians. In a post on X, Prime Minister Narendra Modi hailed the new structure as, and I quote, next generation, end of quote, step towards easing the burden on citizens and boosting economic growth. Well, we spoke with a whole host of industry leaders to understand what the implications of the GST boost could be for their respective segments. I mean, top of mind really is the auto space. And within autos, I think by far the biggest beneficiary, as you can see from what the stock is doing, is Mahindra and Mahindra. So right up in the morning, we had Anish Shah, Group Chief Executive Officer and Managing Director at M&M. Also Rajesh Jujurikar, ED and CEO, Auto and Farm Sector at Mahindra & Mahindra. This is their reaction.
Ushers in a new era of simplification and possibly a new era of ease of doing business as well. It will have a very significant impact on consumption. And this is something that should, in some ways, create that momentum that we were looking for in the economy. A lot of the fundamentals have been in place, but I think this is a very significant move that will create that momentum and propel India to an 8 to 10% growth rate overall. So that is the reason why we feel it is a very important milestone for our economy and sets it up in the right way.
Tractors gets a big boost, 12 to 5%, which will lead to prices coming down 40 to 60%. There is limited time to capitalize the upside in the festival period. We are literally 20 days away from the festival period. We can't increase capacities or production outputs. Festival period is a 30-40 day period. So I honestly don't think we're going to get a wholesale billing upside in the short run. This is more a long-term game.
That's autos for you from Mahindra & Mahindra. Now, consumer durables and ACs as a segment are expected to see a big boost as well. So we spoke with B. Thiagarajan, Managing Director at Blue Star, to understand how this will impact consumption. And Mr. Thiagarajan actually shared some numbers with us. Listen in.
See, I will also tell you, we had shared the figure that even though the summer season was washed out, the year began with an expectation 25 to 30% growth in FY26 is possible. But when the summer season had been a washout, we felt that 10 to 15% growth only is possible. Now I would say the industry can look forward to even 20% growth for the full year. And it is indeed possible, even though the summer season was a washout. Generally in India, when an announcement is made like this, there is a huge rush. And this will indeed be taking place. And the intention here is to pass on the full benefit to the consumers, right? And that's what we will do.
Okay, now to insurance, which I think where it's a little more complicated. Now on life policies, term policies, health policies, the premium, the GST rate has been reduced to zero, nil. But will that mean that your and my premium, which insurance companies charge us, is going to go down? Not necessarily. We spoke with Yashish Daya, Chairman and Group CEO at PB Fintech, and of course, Shriram Finance's Umesh Revankar as well. Listen in.
So it is not like one is making too much money or anything of that sort of profit. Terms like profiteering, etc. do not. Which insurance company is making crazy profits? And which distributor is making crazy profits? Right? As a percentage of premium. If the benefit is 18% and the cost is 5% or 10%, a benefit is going to the consumer, is it not? Right? Whatever the industry can afford, it will take.
We have been planning for 15% growth year on year. We should be able to grow maybe a higher number at 17, 18%. It all depends upon economic activity per se. But I think definitely we will cash on when the sentiments are better. I think the MSME segment especially will get a very big boost because there will be a lot of consumer item that has come into lower slack and the consumption will increase, more compliance, more movement of goods. So I feel it is an extremely positive move to bring down this slab, make everyone comply and grow the demand.
Okay, well, that's a range of sectors, but we of course will continue to get you more reactions through the course of the day. It's a wrap here on this edition of the Global Reset. As I said, began by saying a bit of global, but more local heavy today. Thank you very much for staying with us. More coming up on the other side.